Let's bring in a couple more voices to talk this over. Bob Doll is CEO and CIO of Crossmark Global Investments, and Andrew Hollenhorst is Chief U.S. Economist at Citi. Great to have you both here. Bob, before I mention, I just want to mention some of these headlines on the newswires. Lebanese troops have pulled back north of the border. We are all aware that the situation in the Mideast may get more intense and may also be putting pressure on the market. So with that in mind, how significant are these remarks from Powell, and which way do you think this sort of gap in the bond markets and Fed funds is going to go?
Yeah, I think you're right to bring up those headlines. They're going to come and go, and it's going to create some volatility in both directions in the market. But in terms of Powell's comments, hard to disagree with anything he said. I guess one of my concerns is we're going to get to 2% inflation, quote unquote. I don't see how we get to 2. We're 2.7 trailing 12 for PCE, their favorite. 2.7 down to 2 is Herculean. And I don't see how we get there without a recession. The other point I would make is I'm really glad he brought up the revisions. Revisions, that's the past, so normally we don't care about those things. But those revisions were so significant, it's hard to ignore them. And I think anybody that's been on the cautious side of the economy has to be pushing their numbers up as a result of the extra income, the extra cash, et cetera, et cetera.
So, Andrew, why don't you jump in and react to what Bob said there? I mean, in other words, he's skeptical that the Fed is going to get to 2%.
Yeah, I think what we heard from Powell is that there's a lot of belief now amongst Fed officials that we have core PCE running at 2% on a 3-month annualized basis. Now, I agree with Bob. There are some real long-term issues here. We have a structural shortage of housing. Housing can reemerge as an upside risk to inflation. But I guess agreeing with Bob that if the labor market is weakening, then you're not going to have that resurgent demand for housing, even as interest rates come down. If the labor market is weakening, you're not going to have as much upward pressure on wages. So cyclically, I at least see this story where they do get back to a lower rate of inflation. I think they're feeling enthusiastic about that. But to Bob's point, I mean, I'm not sure that that's happening in a world where we have no concerns about downside risk. The point that I would disagree with Chair Powell is that we don't see anything that makes us concerned about recession. We've triggered the SOM rule. We have a movement up in the unemployment rate that we typically only see during a recession. So I think we should at least be concerned about it. That not everyone has that as their base case, but it's at least a concern here.
Andrew, is this, Steve, just real quickly before we move, Andrew, is that, though, a reflection of more labor supply because of immigration or anything? I mean, are there dynamics that, again, as Sam herself has said, not, rules are made to be broken? Is that an important dynamic, or are there reasons to dismiss it? Yeah.
I think Powell was kind of trying to correct the record on this, or kind of mark to market where things are now. That was an argument 6 months ago, maybe 3 months ago. What we've seen over the last 3 months, and Chair Powell said this, is the pace of payroll job growth has slowed. It's slowed to something that we usually only see at the beginning of a recession. So this really is weak labor demand that's driving the unemployment rate higher now.